So, thank you so much everyone for coming yesterday and the questions. I really enjoyed them. The questions were all fantastic and gave me the opportunity to talk about stuff which I feel passionate about, so thank you so much for that. Today we're changing tack a little bit. I guess when you're a fund manager, there's kind of two sides to your network. On the one side, there's the investors, and yesterday was for my investors, and the other side of the network is, of course, my peers and the fund managers. And as a one-man show, I'm particularly dependent on my partners for exchanging ideas and generating ideas, and so today is really for you guys. And so we're going to divide the session really into kind of two parts. I'm going to start maybe talking just a little bit about my story, because I know a lot of you are kind of interested to hear how I got started, and also kind of talk about some of the lessons I learned along the way. A lot of them through good fortune, some of them through having the right people to kind of influence me at the right time, and maybe one or two as well from having the right idea. Yeah, so that will be the first part, and then after that I'm going to invite four of my partners to come up. They represent different types of investors. So there's a family office, there's endowments, and there's a kind of a one-man show who also picks investors. And all these four people have one thing in common, in that they were kind of crazy enough to invest in an unproven young fund manager. And of course, these are the kind of the people, if you're in the process of starting a fund or want to start a fund, or have already started your fund, of course you should want to attract. And so your opportunity is to ask them what they kind of look for in fund managers, and hopefully take that input on board and make sure your own businesses are kind of reflecting being attractive to those type of people. So I'll invite them up in about 30 minutes or so, and but I'm going to start off just talking a little bit about my story. So I had, I guess, a fairly traditional kind of finance background. The first 7 or 8 years of my career, nothing too spectacular. And the one date, I guess, when I really started to become a value investor was after the dot-com bust. So after in 2002, all these internet stocks, which had previously been these very high-flying IPOs, suddenly all got completely beaten up, and were so out of favor that many of them were trading at huge discounts to their cash they had on their balance sheet, and some of them even had some pretty decent businesses on top of that. So as even a not particularly experienced investor who'd never heard of Warren Buffett or Ben Graham, I kind of knew a bargain when I saw one. And so I started investing in these companies by myself, and this was at a time when the markets were in depression, the banks were all in pretty much shutdown mode, and people didn't really have much to do in the bank I was working at. But I was working like crazy because I was seeing these amazing opportunities, and but trying to kind of keep it a little bit to myself, because I didn't want to give away what was happening. But one of my friends and colleagues who was in the room with me saw me sort of working very hard, and didn't make sense to him, and he sort of said, "Well, what are you doing there?" And I was, "No, nothing." And he was, "No, you're definitely doing something." And and so I told him about these sort of stocks which were trading below their cash, and after that we started collaborating on the research together. And it was just as well we did, because there was one morning he kind of came bouncing into the office and said, "Rob, you're just not going to believe what I found. There's this book, it's called The Intelligent Investor, and you've just got to read this one paragraph." And so he flicks forward to whichever chapter it is, and there's a paragraph which talks about the big crash in 1929, and how afterwards stocks become so out of favor that these previously high-flying companies are even trading below their net cash. And I was like, whoa, this is almost scary, that it was something written 70 odd years ago, and was so precisely describing what we were seeing then. And since that experience, I've kind of read everything I possibly could about value investing, and really enjoyed the journey. So that's kind of how I started getting into investing. And then if I scoot forward a few years, I moved to Switzerland, I think in around 2004, and was working for a kind of an activist fund here in Switzerland, whereby the capital came mainly from one family, so it was a kind of a mixture of a fund and a single family office. And that was a great experience. As activists, they were taking very large concentrated stakes in companies which were completely illiquid. And so, rightly, the principal placed a lot of emphasis on the research before investing. He wanted to make sure every possible imaginable risk had been covered before we made the investment. And so from that period, I really learned the value of scuttlebutt, of visiting the suppliers and the customers, and really trying to figure out what a company does. But there was, if I scoot forward again to around about 2006, there was a kind of a falling out in this family office. So there was a principal, this sort of 80-year-old, very patriarchal, cool Italian gentleman, or Swiss-Italian gentleman, and a kind of an ambitious, maybe 40-year-old managing director who was keen to open the fund up to third parties and grow. And I guess they had a big falling out, as a result of which the managing director went off and set up his own fund. So without necessarily really thinking about what I wanted to do at the time, I was suddenly forced to make a kind of career decision. Did I want to stay where I was, or did I want to go to work for this other guy? And as I was sort of toying up both the options, basically, what I concluded was, actually, I would much prefer to work for myself. And so that was really, I guess, lucky that I was forced to kind of make that decision. And I think that year was also the first time I'd been to Berkshire Hathaway, so I'd kind of seen what Buffett had achieved and the way he'd done things, and kind of lots of things came together that I decided, okay, I want to set up my own business. So at the time, it was, of course, my dream, like I guess all of yours here today as well, to run my own fund. But as a kind of a young manager without any kind of track record or brand, or without having worked at some fancy address, it's of course an impossibility effectively to raise capital. So you face this chicken and egg dilemma that people aren't willing to give you capital until you have a track record, but without a track record you can't attract capital. But I'm still super keen to become independent, and what I kind of noticed was that there were at least two people that were interested in my research abilities, so the former family office and this managing director. So I figured there's plenty of capital around. This was 2006, and a shortage of people who kind of can generate ideas and analyze companies. So when I set up RV Capital, what I did in the first couple of years was effectively, I would describe it as a kind of an outsourced buy-side analyst. So I would source and analyze investment ideas for various clients, which were, well, I'll come to that. So when I set up the company, I was very keen not to approach anyone before it started, because it was it was a big responsibility for me with a young family to be out on my own. I thought it was unfair to speak to potential clients beforehand and saying, hey, I'm going to set up my company. You're going to be a client, right? You're going to take care of me. And I didn't want to put that pressure on anybody. But the day after I had set up the company, the first call I placed was to Jens, who is here with us today. He's the managing director of the Rentrop family office, and I said, that I'd set up on my own, and I'm looking for clients, and I think I'm a smart analyst. Is there something we can do? And fortunately, they invited me to Bonn, and I think pretty much after the first meeting, they said, "Yeah, we want to support you." And the deal we struck was something along the lines of they would pay me a certain amount a month. I think it was about 4,000 euros. And the idea being to kind of give me a little bit of money to live off and pay for travel and all that kind of stuff. And in return, I would find investments and We would jointly decide whether they would be invested in or not, and to the extent they worked well, I would share in the upside of those. This sort of went on. I also won some other clients as well, which isn't so relevant to the story. So if I scoot forward again to another 2 years, so now to 2008, I was effectively managing an account for the family office, which had risen to a decent amount, and at the same time, the family decided to set up an investment company, which is called the Investment Aktiengesellschaft für langfristige Investoren, which is a bit of a mouthful. It means the investment company for long-term investors, just in case anyone is in any doubt about whether they should be going there or not. And so I was managing this money, and I said, listen, it's a big dream of mine to manage my own fund, and there's this sort of pool of capital I'm managing for you effectively anyway. Would you mind if I kind of use that to seed my fund? And fortunately, they agreed to that, and so that's how Business Owner got started back in 2008. The name Business Owner came from a couple of sources. So as I mentioned, I had this sort of background as an activist investor, and I think the activist investment style is a perfectly legitimate one. The idea is you find these poorly run companies with bad managers, and you take a large enough stake to initiate change, and when that change happens, then hopefully the company becomes more valuable. I think it's a great strategy. It just has the problem that you're always effectively dealing with assholes. Almost by definition, the manager has to be incompetent or dishonest or normally both, and so you're kind of always basically fighting someone. And I've never really enjoyed conflict as a person. And I certainly don't enjoy having to deal with assholes the whole time. So what I did was kind of flip the activist idea on its head, and said to myself, okay, if the activist thesis is these companies with poor managers, no real owner, very inefficient and poorly run, there must be a flip side to that. That companies with good long-term owners who are thoughtful, engaged, are better companies. And I very much believe that that's the case. And the great thing is, oftentimes, these companies also trade at a discount to comparable companies, because the market as a whole doesn't like it if there's this kind of long-term anchor shareholder. Oftentimes, the liquidity is a little bit less because there's a big shareholder, and there's not the excitement of restructurings and asset sales and M&A fantasy and all this kind of stuff. So for me, it was a powerful insight that you had this sort of superior class of company trading at an inferior valuation. And so that's kind of part of the reason why I called the fund Business Owner. And a second reason was I kind of very much in the idea of Ben Graham, view myself as a business owner and not a kind of a trader of shares. And the third reason was, I was always super keen that my investors didn't see themselves as owning just a stake in the fund or a piece of paper which gave them ownership of the fund, but actually viewed themselves as owners of the businesses we were investing in. And that's why I was super happy to do the meeting over this weekend in Engelberg, which is, of course, one of our holdings, and hopefully gives people a sense of ownership of these businesses and not just ownership of the fund. So that's kind of the story of how I got started. And I think mainly through coincidence, as I said, and also a bit of luck and having the right people help me, I kind of did quite a few things right, if I may say so. And the odd thing is, a lot of these things that I did were the exact opposite of what I see most young fund managers do. And so that kind of struck me as a pretty amazing insight, that you have all these young fund managers who are often, well, actually always ambition and nearly always well-intended, but they're effectively setting their businesses up in a way that they're basically designed to fail. And that's something which, to me, doesn't make sense. What I want in my, out of a selfish interest, I want a thriving network of managers around me with whom I can exchange ideas and talk about ideas with. And that's only going to happen if I help them, if I see they're on the wrong track. So that's a big part of the motivation of holding this event here today. So I'm going to go through maybe sort of 10 ideas which I think are important, and then after that, as I mentioned, we get some of the other investors up and they can give their perspective as well. So the first idea I want to mention, and it's the crucial one. If there's one idea you take away today, it really should be this, and that is you have to get it right. You have to get the structure of your business right on day one. You have to get it right on day one. On day two, it's too late. And the reason for that is the way you sort of set the business up in an incredibly powerful way starts to generate a certain dynamic of its own. In the investor, depending on how you set it up, it attracts a certain type of investor who then, of course, tell like-minded investors about it. So all these things start to compound over time. So you have to get it right structurally on day one. And when I say structure, all of my remaining comments are going to be about that structure. But when I talk about structure, I don't mean should it be a Cayman fund or CCAV or Luxembourg, all of that stuff. I'm not a lawyer and I don't understand any of that stuff. What I mean is it has to have the right structure in terms of giving you the opportunity to manage capital well. Okay, so what does this mean? The first point is the structure of the fund has to fit the strategy. So if you're a stock picker, and I think probably everyone here today is a stock picker, if you're not, none of this is probably relevant. But if you're a stock picker, you have to have a fund structure that allows you to pick stocks. Sounds obvious, but the problem is that the most normal types of structures, for publicly marketable equity funds, have very strong regulation around the whole idea of diversification. So it effectively forbids you from taking concentrated portfolios in companies. And having a concentrated portfolio is no guarantee that you're going to beat the market. But having a diversified portfolio is a guarantee that you're going to be roughly in line with the market. So if you think you're a stock picker, then you need a structure which allows you to do that. And I was always super keen. I was a passionate stock picker before I started, and it was always clear to me I needed a structure where I was able to do that. And it was kind of funny at the time because the only type of structure, at least in Europe, where you're allowed to have a concentrated portfolio is a hedge fund like structure. The public funds, you're not allowed to do it. And so quite naturally I chose a hedge fund structure. But I noticed, and pretty much no one else did that, and the reason was that kind of a long only equity portfolio in a hedge fund structure was basically a product without a market. So not many people can invest in hedge funds, and those that can have some kind of a sort of a long short, market neutral, volatility minimizing type of aim or whatever. And I had a hedge fund, but I don't short stocks. I don't aim to be market neutral in any way. So it was basically a kind of a pot that didn't have a lid to go with it. And that was kind of frustrating in the early years because not many people were interested in the fund, and those that were often couldn't invest. So that was kind of frustrating from a kind of business growth perspective, but it was great from a capital allocation perspective because I could invest the way I wanted to. And if I kind of scoot forward 10 years to today, it's a real entry barrier for the business because the difficulty I had to get started, other people will also have, and there's not many long-only equity funds with that type of structure. So you have some short-term pain doing it that way, but I think a lot of long-term gain. The next point, I think it's super important to understand, is that you shouldn't waste time marketing. Now, this is a lesson that I kind of didn't understand properly right at the beginning, and kind of came to by default. So when the fund started, I thought, okay, now I'm a fund manager, I need to go out and find some clients. And most people didn't want to hear from me, but I was persistent and had recommendations of people I could talk to. And so as soon as someone said, yeah, okay, you can come round, I would sort of be out there to speak to them. And it was an incredibly frustrating experience because, of course, most of them weren't interested, and they weren't interested for very banal reasons, like, we need a longer track record, or we can't, the fund is too small, we can't invest in a fund which is only 10 million big or whatever. And it was super frustrating. I'd spend an hour or more explaining how I invest, talking about some of the companies, and then someone would say, oh, we can't invest in something which is only 10 million. I'm like, couldn't you have told me that at the beginning? So I basically gave up on marketing more out of frustration than strategy, and just concentrated on allocating the capital properly. And that was great that I did it, because the type of investors I was approaching were definitely the wrong ones for me. It meant I was spending all my time managing capital, which is the best way to guarantee, or to, if you're aiming for a good track record, that's the best thing you can do. And above all, I noticed over time that every now and again someone would reach out to me. The people that reached out to me were people who knew I was small, knew I was young, knew I had a concentrated portfolio. So they effectively sort of self-selected for my strategy. So when they did reach out, and when I did speak to them, it was a very productive conversation, and most of the time they would actually end up investing. So although I can understand at the beginning this may be tempting, or to want to raise capital and stuff, I really think the best route to go down is to focus on generating a great track record, and over time people will find you if you do that, and the people that do find you will be a much better caliber of investor than the ones you might find just by kind of going out and knocking on doors. So that takes me to my next point, which I think is also fairly counterintuitive. So I talked about being patient and not marketing, and just waiting for the right people to find you. And that feeds into this point, which is you need to keep cost ultra low. It kind of saddens me to see a lot of young fund managers go in exactly the opposite direction. So a lot of young fund managers will hire fancy offices, and if it's in London, it will be in Mayfair or New Bond Street. They hire an analyst, maybe a receptionist, so they're kind of starting right off of the bat with a huge amount of monthly expense, and presumably because they hope it's going to create credibility or who knows what. But the type of investor you're looking for doesn't care about whether you have fancy offices or not. They care about whether you can beat the market. And so it's a kind of a waste of money, and it will most likely lead to you ruining your track record, because how on earth are you supposed to be patient and long term if you've got an enormous amount of expense going out of the door every month? And I've seen that many times with fund managers, when I talk about how I'm invested in company XYZ, and maybe in the short term the perspectives don't look so rosy, but if you can afford to wait a little bit, things will turn around. And they say to me, we don't have the luxury of doing that. We have to show performance fast. And we have bills to pay. And even though they started with the right intentions of buying the right companies and being long term, they're effectively, through the structure they've created, forcing themselves to kind of fall into that treadwheel of chasing the short term opportunities. Then the next point I'd also make, I think it's also counterintuitive, is I would avoid, a lot of young managers, talented young managers, get these kind of offers from promoters along the lines of, we'll give you a certain amount of start capital, but in return you have to give us kind of 40 or 50% of your business. And as tempting as that is, because it kind of gives you a risk-free way to get started, if you genuinely think you can put together a long-term track record, I would really recommend avoiding that type of offer. There's a huge conflict of interest between the promoter and the fund manager. Now, the promoter is purely short-term, financially interested, so he's going to be focusing very much on monthly or daily numbers. He's going to be encouraging you to go out and get marketing, because his interest is in the fund being a financial success for the owners, and not a financial success for the investors in the fund. So I would avoid that kind of structure, and I think it's kind of doomed in the medium term, because if you are doing well and starting to build a good track record and attract good investors, there's going to come a point where you say to yourself, why am I paying a 50% tax to some dude who probably didn't do anything for me, even though he promised it? And that's going to fester and become more annoying over time. The more successful the fund comes, and it's going to lead to a split at some point. And it also means there's less, to the extent you work with other people, there's less share of the company for your partners as well. And I was very influenced in this respect by David Swenson's portfolio management. He talks a lot about, in that book, about how, he talks in general a lot about the structure of funds that young managers should aim for, so I can strongly recommend it. But he also makes the point that if he sees a kind of a bad ownership structure of a fund, then he's going to avoid it. Then the next thing, which I think is also counterintuitive, is I think you need to communicate in as open and as transparent way as you possibly can with your investors. And that was kind of super, that was a kind of super controversial idea when I started. So there was this kind of idea when I started that hedge fund managers or fund managers should be super secretive about what they're investing in, because investment ideas are very valuable, and they effectively saw it as a kind of an intellectual property which they wanted to keep on a very proprietary basis. And I decided to kind of go the opposite route for two reasons. One, the first one was what I kind of realized early on through speaking to my investors is, of course, there's a kind of financial component. When they invest with you, they're hoping for a good financial return, and that's clearly their priority. But they're also looking for a good emotional experience. So they want to feel relaxed and comfortable that they know where their money is and who's responsible for it, and that things are being taken care of no matter what's happening in the world. And I think the only way you can give people that emotional comfort is to kind of explain in simple terms as possible what exactly you're doing. So I think that's an important point. And then the second point was, it was kind of clear to me that although I was confident that I would be able to put together a good track record over a long period of time, I thought that might not be sufficient to make it as a fund manager. Because if you kind of show up out of nowhere, 5 years into the start of your fund and start telling people, oh, by the way, I've been compounding at 20% per year for the last 5 years, they're probably going to be a little bit skeptical about how real those numbers are. And even today, sometimes I see these some fund managers send me a kind of a fact sheet or some note type thing saying, yes, last year once again, we were up 30%. Hey, it wasn't quite as good as the 40 the year before, but 30% is also okay. And I'm like, I don't know whether it's real or not, but how on earth am I supposed to judge that? So I thought it wasn't enough just to put together a good track record. I had to explain in advance what the philosophy was and explain what the investments are, so people can see whether there's a philosophy they like, whether the investments agree with that philosophy, and whether the performance is a result of that philosophy and investments playing out in the way you'd think they would. And So I think that's been a huge benefit to me of being transparent. And of course, people are fearful of what happens if people kind of copy your ideas or not. And to the extent there's been any kind of loss through that, I think it's been more than offset by the benefits. And actually, there's a third benefit which I would also mention, which is in the time of the internet, people like to pass letters around, and my letters get passed to other managers. Probably many of you here today, and the ones who think it's rubbish probably don't reach out to me, but the things who it really resonates with do reach out to me. So it's been a great way for me to kind of expand my network of like-minded investors. So the next one, which kind of fits in maybe to some of the earlier points, is you really want to get your investors to self-select. So if you reach out to investors, who knows if they're gonna be the right type of investor for you or not. But if you just lay out how you do things in a transparent way, and people come to you, then they pretty much self-select, and that's a very powerful flywheel, because they maybe invest and have a good experience, and then they refer you then to similarly like-minded investors. So you get this amazing kind of virtuous circle going, that you're doing things the right way, and then you're attracting investors who are investing because you are doing the right way. So it kind of provides a reinforcement to continue doing it the right way. And so because you continue doing it the right way, you become more successful and attract more of the right type of investors. And it's an amazing flywheel. And you can imagine how that works exactly in reverse if you're starting off with one or two of the wrong type of investors who may be a very short-term focus. So maybe you start posting very good short-term monthly numbers, and they're getting super excited and recommending to their friends who are also super keen to make a fast buck. And when of course you have a couple of bad months or a couple of bad quarters, which happens to everybody, these investors are gonna leave, and that's going to be very bad for your confidence and for your business. So what that also, the kind of the flip side to that is also, and this is very tough, and I really applaud people who manage this, but you really have to say no to the wrong type of investor. Some of the investors who reached out to me in the very early years said, yeah, this is, we like your fund, but we really need daily liquidity or something like that. And so then the kind of the natural reaction is, maybe I should have daily liquidity, because wouldn't it be great to get this investor? But someone who's interested in daily liquidity is thinking of the fund as a bank account and not as a long-term investment. And you really need to say no to them, as difficult as it might be. And that's also an argument why I would never hire someone in a kind of a marketing type function, because someone in a marketing function quite correctly will go out there and speak to as many potential investors as possible and come back with all this great feedback of if the fund was more liquid or more diversified, there'd be a much bigger potential market for it, and that advice is correct in terms of the feedback the salesperson has been getting, and it's aligned with his incentives, which is to generate business for the fund. But it kind of forces you into making the type of compromises which you really don't want to make, because you want to be focused on a structure which is right for the capital allocation, and not a structure which is right for the marketing. Then my next point is to seek responsibility. For me, it's obvious if your dream is to be a fund manager, then having made it to be a fund manager, then you want to be the one calling the shots, right? The reason I didn't want to go and work for any of these other guys is because I was going to be the number two doing all the work, and then someone else who was much less well informed about the company was going to be the one making the investment decision. And I really hated that idea. So as soon as I had the opportunity to start my own fund, I was super keen to have the responsibility for that. And it seems like it's stating the obvious, but when I see other fund managers, I see them do the exact opposite, which is, as soon as they get started, they start hiring compliance officers and analysts and co-fund managers and stuff, and it strikes me that the purpose of all these employees is often to kind of diffuse the responsibility, so nobody really knows who ultimately is actually making the decisions, and I think that's not a very attractive perspective for a potential investor in the fund. I think a potential investor loves to know who has the authority and who has the responsibility, and there's a lot of positive emotional value in that as well. Then the next point, there's only two more to go and I'm done. The next point is, I think you need to think of your fund as a business, or analyze your own fund in the same way you might analyze a potential investment. So, you want to, around your own capital allocation, you want to, or your own business, you want to create a moat in the same way you would seek a moat in someone else's business. So how do you create a moat for your business? I think there's lots of things, but ultimately what you're trying to do is find a structure and a group of investors that give you permission to invest with a very long-term perspective, and that's incredibly rare in this. In the financial services industry, most people have very short-term horizons, even if they have potentially long-term capital. And it's too difficult chasing these sort of short-term quarterly earnings type opportunities. The far easier opportunities is just buying great companies when they're a little bit out of favor, knowing that you have the time to wait until they come back. And that involves really building up a loyal investor base that give you permission to do that, and that's an incredibly powerful moat for the business. And then my last point, which is I think a great one to move over to the next section, is to really seek great partners. I think I've been incredibly lucky with the partners I have, starting right off from the beginning with the Rentrop family office and a lot of my other partners, a few of whom you're going to see in a few moments. And so you can judge for yourself, but I'm pretty sure you'll agree. And it's amazing how good partners can really help you. When you're doing things the right way, they provide you with encouragement, which is fantastic. And they also challenge you. So if I think of all of my partners, they normally meet with me at least once a year, sometimes more, and they will really challenge me hard on the way I'm investing and the companies I've invested in and why have I done it, and what is the thesis, and I actually welcome those questions because it's an amazing opportunity for me to kind of to be challenged by thoughtful people who've taken the time to really understand what I'm doing, and oftentimes through that kind of questioning process, I'll find inconsistencies in how I'm investing, or and then that's great because I'm not trying to climb a career ladder. I'm trying to build a long-term track record. So if I can find something I'm doing wrong or could be doing better, then that's perfectly fine by me, and that's been a real benefit from some of the partners I've had. And I sometimes joke that if I should probably be paying them for for the meetings we have.
That's a good idea.
Okay, I think that's a great point to stop. I'm not going to take